Financial navigators. As of January 26, 2026, the global economy is holding its breath. President Trump has just issued a stark warning: a 10% tariff on goods from key European nations, France, Germany, and the UK, is set to kick in on February 1st. This isn't just another trade dispute. It's a direct escalation, aiming to pressure allies who oppose his geopolitical ambitions, particularly regarding Greenland. This move sends a shockwave through established trade routes, supply chains, and investor confidence. The question on everyone's mind is no longer if a trade war will escalate, but how deeply this new front will reshape our interconnected world. Get ready, because the ripples from this 10% tariff bomb are about to hit every continent. Let's start at home. The immediate impact of a 10% tariff on European goods will likely hit the American consumer directly in the wallet. Think about those luxury cars from Germany, French wines, British fashion, and countless specialized industrial components that often contain European parts. Importers will face a choice: absorb the 10% cost, which eats into their margins, or pass it directly to you, the consumer. Historically, tariffs mean higher retail prices. This isn't just about high-end goods, it trickles down. Manufacturers relying on European components for everything from electronics to machinery will see their costs rise, potentially leading to increased prices for finished products. Prepare for your favorite European imports to become a little more expensive, tightening household budgets already strained by inflation. For businesses in France, Germany, and the UK, this 10% tariff is a direct punch to their export revenues. Imagine a German automaker selling a car for $50,000 in the US. Now, that car effectively costs $55,000 due to the tariff, making it less competitive against American or Asian rivals. Smaller businesses, especially those in niche markets like specialty foods, textiles, or artisanal products, could be devastated. Many rely heavily on the US market for their sales volumes and profit margins. This tariff creates an immediate barrier to entry, forcing them to re-evaluate their entire US strategy. Some may cut prices and take a loss, while others might simply exit the US market altogether, leading to job losses and economic contraction in Europe. Wall Street is already reacting with increased volatility. The S&P 500 has seen swings directly tied to tariff rhetoric. While some domestic sectors might initially cheer the idea of less foreign competition, the overall market effect is usually negative due to uncertainty. Companies with significant European sales or complex supply chains involving European components will likely see their stock prices suffer. Tech giants, whose global operations are deeply intertwined with Europe, face profit warnings. Investors hate unpredictability, and these tariffs introduce a massive layer of it. Expect continued choppiness as the market tries to price in the full impact, with potential sell-offs in sectors most exposed to transatlantic trade. Asian economies, particularly China, Japan, and South Korea, are watching this closely. On one hand, there's potential opportunity. If European goods become more expensive in the US, Asian exporters might step in to fill the gap, offering competitive alternatives. This could lead to a boost in exports for certain Asian industries. However, there's also significant risk. An escalating trade war between the US and Europe could easily spill over, leading to a global economic slowdown that would inevitably impact Asian export-dependent economies. Furthermore, if the US extends tariffs to more nations or regions, Asian manufacturers could find themselves next in line. It's a delicate balancing act, with some looking for gains while others brace for broader instability. Africa, often considered outside the immediate G7 trade wars, will still feel the effects, primarily through two channels: commodity prices and foreign investment. Many African nations are heavily reliant on exporting raw materials, oil, minerals, agricultural products, whose prices are sensitive to global economic health. A US-Europe trade war could slow global growth, reducing demand and driving down commodity prices, hurting African economies. Furthermore, foreign direct investment from Europe and the US, crucial for Africa's development, could diminish as companies in both regions become more risk-averse or focus on domestic markets. While not directly targeted, Africa will be caught in the economic crossroads, facing reduced export revenues and potentially less development funding. Latin American nations face a mixed bag. For countries with strong existing trade ties to the US, like Mexico, there could be an indirect benefit if US demand shifts from Europe to closer, tariff-free partners. This could boost exports in certain sectors. However, many Latin American economies are also tied to global commodity markets, similar to Africa. A global slowdown triggered by the US-Europe trade spat would suppress commodity prices, impacting their export revenues. Furthermore, some Latin American nations rely on European investment or trade. They might find themselves needing to pivot their trade strategies, potentially seeking new partners or strengthening existing regional blocs to mitigate the impact of transatlantic friction. The global supply chain, already stressed by the WHO exit and the push for reshoring, is about to be redrawn. Companies that source components or finished goods from Europe for the US market will frantically search for alternatives in Asia, Latin America, or even within the US. This isn't an easy or quick process. It involves new contracts, quality checks, logistics, and often higher costs. The tariffs could lead to permanent shifts, as businesses seek to de-risk their operations from geopolitical tensions. This remapping will be costly and inefficient in the short term, but could ultimately lead to more diversified, albeit more localized, supply networks in the long run. The era of seamless global production is under severe threat. The European Union's response will be critical. Historically, the EU retaliates against US tariffs with reciprocal duties on American goods. This could mean tariffs on US agricultural products, bourbon, Harley-Davidson motorcycles, or tech goods entering the EU. Such a move would further escalate the trade war, harming American exporters. The big question is how united the EU will remain. While France, Germany, and the UK are directly targeted, the entire bloc will feel the pressure. This situation tests the EU's ability to present a unified front against external pressure, potentially strengthening calls for greater European economic independence and reducing reliance on transatlantic trade. The US dollar's role as the global reserve currency could face further scrutiny. In times of crisis, the dollar often acts as a safe haven, strengthening initially. However, prolonged trade wars and geopolitical instability can accelerate de-dollarization efforts by other nations. If the US is seen as using trade policy as a political weapon, countries might actively seek alternative currencies for trade and reserves to reduce their exposure to US policy whims. This 10% tariff, while aimed at Europe, adds another layer of incentive for nations to explore alternatives to the dollar, chipping away at its long-term dominance. The dollar might feel like a fortress now, but it could become a long-term target. This entire tariff threat, let's remember, is explicitly linked to President Trump's Greenland ambitions. The administration views Greenland as a vital strategic prize, critical for Arctic security, resource access, and geopolitical leverage. The refusal of key European allies to back this initiative has clearly irked the White House. The tariffs are a coercive tool, designed to force European nations to either support the US position on Greenland or face economic penalties. This highlights a shift in global power dynamics, where economic leverage is directly tied to territorial and strategic objectives. Greenland, a remote island, has suddenly become a central chessboard piece in a high-stakes global game. So, What does this all mean for you and your investments? We are undeniably entering a new global order defined by protectionism, economic nationalism, and direct geopolitical pressure. The old rules of seamless global trade are breaking down. Investors need to prioritize domestic exposure, resilient supply chains, and companies with strong balance sheets that can weather volatility. Diversification across different asset classes, including commodities and potentially alternative currencies, becomes even more critical. This is a time for caution, strategic re-evaluation, and understanding that political decisions now have immediate, tangible financial consequences across every corner of the world. Stay informed, stay diversified, and prepare for continued turbulence.